Good afternoon. A very warm welcome on this chilly day to our webinar providing an update both on UK tonnage tax and on international tax. This webinar is hosted by Maritime London in partnership with BDO. We also have the support of our good friends at the UK Chamber of Shipping. Unfortunately, our CEO, Josh Standerwick, is ill-disposed today, so I've stepped into the breach to act as moderator today. I'm Richard Greiner, a director of Maritime London and a keen proponent of the UK Tonnage Tax Regime over what is almost a quarter of a century now. Unbelievable. Our agenda today will cover the fundamentals of the UK Tonnage Tax Regime. That could be a webinar in its own right, but fortunately it's not. More importantly, perhaps, the recent amendments to the UK Tonnage Tax Regime. Then, with an amazing degree of topicality, as Ken will say a bit more about later, an update on the UK transfer pricing rules, and as well as that, an update on the implementation of a global minimum tax rate and other OECD related tax matters. And then after the presentations within the webinar today, we'll conclude with a panel discussion on all the topics covered, including the future of tonnage tax. So let me just take a brief moment to introduce our panelists today. Joining me on the panel today, we have firstly James Bailey, who's a director in the Corporate International Tax team at BDO. James specialises in providing corporation tax compliance and advisory services to companies in the shipping and related maritime industries. This work includes that with a number of groups in the UK tonnage tax regime. Ken Almand is a partner in the transfer pricing team at BDO. Ken is a partner in an award-winning UK transfer pricing team. He has more than 25 years of experience specialising in transfer pricing, including in shipping and related sectors. And our final panellist is Katrina Ross, who's Policy Director with responsibility for commercial and governance at the UK Chamber of Shipping. Katrina leads on all commercial and governance issues for the UK Chamber. Her varied responsibilities include tax and economics, international trade, commercial shipping policy, and green and sustainable finance. All of us and our respective organisations are deeply involved in the support and development of the UK tonnage tax regime. Just before we get started, a couple of housekeeping points, if I may. The session is being recorded. This is a live webinar. I'm alive. And while, of course, we do not anticipate any technical issues, these do happen. And if they do, please bear with us. You will be able to ask questions in the Q&A area, the second tab on the chat function, which you should be able to see in the right-hand side of your screen. We will look to answer as many questions as we can towards the end of the webinar. However, we do have a tight time frame today, so my apologies in advance if we cannot field all of the questions live. Any questions not covered will be picked up and responded to by the appropriate panelists after the webinar. As I said, this session is being recorded and it will be sent to all attendees after the webinar together with the slides. So, without further ado, over to our presenters today, my former colleagues from BDO, James Bailey and Ken Almand. James and Ken, over to you.
Thank you very much, Richard. Thank you. Just waiting for the slides to come up as well, please. So as Richard says, Ken and I work at BDO and today we'll be presenting on the UK tonnage tax and an international tax update. What that will cover is I will start with an overview of the tonnage tax regime in the UK and some of the recent changes. Ken will then speak to you about the updates in transfer pricing legislation. And then we have a further update on the international tax, global minimum tax reforms. So to start with, in terms of UK tonnage tax, I'd like to start with, I guess, just a very brief overview to give you an idea of what the regime is. So it was introduced in 2000, and despite the name, tonnage tax is not actually a separate tax in its own right. It is a form of corporation tax, and it is an alternative method of calculating those profits which are subject to UK corporation tax. What it looks at is an alternative method of calculating it. So it is a deemed level of profits based on the tonnage of the vessels operated. And so that replaces the operational profits and losses that you would normally see and any gains or losses on the sale of vessels. What I've done is included a little table there to show you just an illustration of how this works. So you would look at the net tonnage of the ship and you have a daily profit based on that tonnage as a sliding scale. In this example, I've taken a 30,000 net tonnage vessel. So working through that calculation, it would be deemed to have a profit of for an annual profit of around 36,000 and corporation tax thereon of just over £9,000. As I say, the idea of this is it's designed to be quite a stable and low level of taxation for a vessel owner and operator. The idea is it replaces kind of the cyclical nature of profits or losses over the life cycle. Important thing to note here is that tonnage tax is what's referred to as a ring-fenced activity. What that means is that the taxation is based on the qualifying profits under the regime, and anything else that falls outside of that ring fence is subject to corporation tax in the normal way. So if you're also undertaking certain investment activities, they would not necessarily fall within the tonnage tax exemption here, and they would be taxed under normal corporation tax principles. And when we look at what are the qualifying requirements for UK tonnage tax, I've tried to split this into three very broad and key areas. So that's in terms of the vessels themselves, the qualifying conditions on the company, and then an associated training commitment. So when we look at what qualifying vessels, they need to be seagoing of 100 tons or more, and they need to be used for the carriage of passengers or cargo by sea. UK tonnage tax also extends that to towage, salvage and other marine assistance, as well as a broader category of transportation in connection with other services necessarily provided at sea. So it provides a slightly more wider scope of taxation to allow you to qualify depending on what your vessels are doing. When we look at the qualifying conditions, what we are looking at is companies within the charge to UK corporation tax, which operate those qualifying vessels. And to operate, what that generally means is you would either need to own or bareboat charter in those vessels and then operate them without kind of any other exclusions. There are some for if you were to say time chartering in addition vessels, there are limited circumstances where that may also be included. When we look at what that means in terms of what that UK company would be doing, those vessels need to be what's known as strategically and commercially managed in the UK. Now that's a dual test, so both the strategic and the commercial management tests need to be met. And what do we mean when we look at strategic? Well, strategic is those high-level decisions concerning the fleet and the vessels. Examples are obviously decisions to purchase or to sell vessels. And when we look at that, we look at also things like the location of headquarters, senior management, decision-making directors, operational boards, and we're making sure that to qualify those decisions and those people need to be present in the UK. And then when we look at the other side of this test, which is the commercial management test, that is more to do with, I guess, the day-to-day operations. So the chartering, technical management and crewing, again, those would need to be overseen and managed from the UK for you to meet the qualifying conditions. And then the third important component to that is a training commitment. So that's not actually administered and is not actually a tax requirement, but it's administered by the Department for Transport and runs parallel. So every tonnage tax company would commit to training cadets. Very broadly, that's 1 cadet for every 15 officer posts. That training commitment is cumulative. So if in year 1 you needed to train, say, 5 cadets, in year 2 you would need to train another 5 cadets. So by year 2 you're up to 10, and then year 3 it would be 15 in total. And so there's various, you need to make sure that you are keeping within those training commitments. That said, if you do fall outside of those, there is a specific provision which allows you to make payments in lieu of training. But this is generally where that commitment is unable to be met. So, for example, if some of your cadets pull out of their training, or in the initial phases of you entering tonnage tax, where you might not necessarily be able to secure the cadets within enough time. So there is flexibility around that as well. Moving on now to some of the changes and key developments. Well, as I say, tonnage tax has been around since 2000, and actually we haven't seen many changes. It's been a relatively stable regime. Following the departure of the UK from the EU, there were some specific changes to make the regime more flexible and potentially more attractive. And so the first key point here is the flagging rules. So prior to April 22, there was some specific rules about maintaining a level of UK or EU flag vessels within the regime. That has completely gone. There is now no requirement at all in terms of the flagging of those vessels. One thing to consider as well, though, is when you are looking at that strategic and commercial management test, a UK flag is helpful, and HMRC will look at it favourably when considering whether or not the strategic and commercial management of those vessels are in the UK. Another key change is around the election into tonnage tax. So there has generally been quite a strict and rigid rule in terms of when you can elect in and how long you elect in for. So generally, the starting point is that you have 12 months from when you first qualify to elect into tonnage tax. And that is for a fixed period, originally 10 years, but that reduced to 8 years from 1st of April. So any elections made after that run for a fixed period of 8 years. Again, the idea being to reduce that time limit so it is a bit more flexible. When you have made that election, you have the opportunity to renew that election at any point for a further 8 years. If you missed that election, then it did become increasingly or very difficult to actually elect back into the regime. HMRC, recognising that, have introduced what's known as a bridging election. So if after your 8 years you, for whatever reason, did not re-elect and then tried to re-elect at a later point, there is a bridging and renewal election which allows you to maintain and stay within tonnage tax and not fall out. At the same time, HMRC also softened its position in terms of late elections. So if you made an election to enter into tonnage tax outside of that 12-month period, if you had a good reason and could satisfy HMRC, then it would be possible for you to make that late election. And then finally, another important thing to note is that was announced last year is what we have what is known as a new election window of opportunity. This is essentially allows anyone to enter into tonnage tax if they had previously qualified and not elected in, or if they were previously in and fell out of the regime. So this period was open from 1st of June 23 and runs until 30th of November this year. So it allows you, if you were previously qualifying and no longer within tonnage tax, to re-elect in, or if you chose not to. So again, another welcome addition to allow new entrants into the regime. And I think since 2000, we have had only one election window around 2005, 2006. So that is quite a significant change for the regime. And then finally, again, what was introduced and announced earlier last year was the introduction of third-party ship managers allowing themselves to elect into the tonnage tax regime from 1st of April this year. And in terms of what that looks like, so It is limited in scope in the sense that it only applies to third-party ship managers that are managing tonnage tax vessels, where they are contributing to the operation of that ship. It is purely optional, as with all the tonnage tax regimes. You can elect in, and you can elect in after 1st of April 24. The system broadly mirrors that of what you would expect if you were a ship owner and operator. So you would look at the tonnage tax vessels that you manage, and then you would apply the daily profit rates as shown in that table below. One significant point to note is for ship managers, that daily profit rate is reduced, and it's about 1/5 of what it would be if you owned and operated that vessel. So in that example below, you could see that for a 30,000 ton vessel, where for an owner operator it would be 9,000, for a ship manager it will be just over 1,800. Again, important to know that this forms part of what is the tonnage tax ring fence. So any activities that don't qualify will be subject to normal corporation tax in the normal way. So for example, given that the tonnage tax rules only apply to tonnage tax vessels, if those ship managers are undertaking non-tonnage tax management of non-tonnage tax vessels, they would be subject to corporation tax in the normal way. And finally, the other thing to note is there is no cadet requirement for those ship managers. So as a ship manager, you wouldn't also be expected to train cadets as you would as an owner operator. And so that's just a very quick and high level summary of the changes and a summary of the tonnage tax regime. And as I said, now we are going to move on to my colleague Ken, and he will update us on recent transfer pricing changes. Ken, over to you.
Thank you, James. And I should start off by saying that I was working at the Inland Revenue in 1999 in policy, tax policy, and around the introduction of tonnage tax. So I'm pleased to see it's still going strong 24 years later. So transfer pricing. It was mentioned earlier that this is very timely, this webinar, and the reason for that is that earlier today, HMRC announced the responses and next steps on the current UK transfer pricing consultation. I do apologise, I haven't had time to read all of those responses and the outcome before this webinar. I literally found out half an hour before. I've had a very quick skim through, but I'll give you some outcomes when I've just given you some flavour of the overview and the context. So why did the UK feel it was necessary to have a consultation? Well, we've had no new substantive transfer pricing legislation since the early 2000s, either for TP or for permanent establishments. And during that time, of course, there's been a lot of experience at HMRC dealing with taxpayers, customers, whichever you like to call them, transfer pricing inquiries, working with other countries. And obviously, during that time, the policymakers at HMRC and HMT have looked at the UK legislation and perhaps felt it needed modernising. And of course, we've had a lot of work during that time by other parties, notably the OECD, also the United Nations, European Union, and others. I guess in particular, the BEPS publication in 2015 was a sea change, really, in terms of international transfer pricing principles and rules. And effectively, this consultation is HMRC's rather belated response to BEPS and other developments in terms of modernising the UK rules. In particular as well, we've had further OECD updates in 2020 around financial transactions. Before then, the OECD guidelines were pretty silent on the issue, but we've had developments in that field, and also there's been quite a lot of case law. Less so in the UK, although we've had a couple of cases, but internationally, quite a few cases on financial transactions and transfer pricing. So the aim of the consultation was to ensure consistency with these updated transfer pricing guidelines and double tax treaties. Also to simplify and clarify the UK legislation, and also to give increased certainty. So those were the aims. The consultation was launched last summer. As I say, we've just had the responses and the next steps today. So just let's have a look at the overview of the key proposals in the consultation. As I said, HMRC are looking for views, or were looking for views, on improving certainty, in particular in relation to three key conditions. One was around this phrase or this word in the UK legislation of a provision. So this was inserted into the legislation back in the 1990s when the legislation came into force, and the idea really was it was wider than just using the word transactions. And it's supposed to cover the conditions made or imposed between two enterprises in their commercial and financial relations. There has been a feeling for a long time, though, that the word provision was unclear. People didn't really know what it meant, and it doesn't really comply with what the OECD now use. So that was one of the key issues. The other was around, let's call it, control and connectedness. And in the UK statute, we have this participation condition, which again, some felt was overly complex and needed modernising. And thirdly, the tax advantage rule. So again, in the UK legislation, we have this concept of a one-way street. So the legislation only works if it's to increase the UK tax take. It doesn't. You can't use the transfer pricing to benefit yourself by reducing your UK tax liability. So those were the three key areas that the consultation were looking at, but there were others as well, which we'll come on to. So the changes are also being considered in respect of the taxation of intangibles. Currently, the statute in many situations requires two valuations around the transfer of intangible assets, one for the market value and one for the arm's length value. And this can be very frustrating, and people say, well, isn't that the same thing? It causes a lot of additional work, the need for two valuations, so that's been a key issue under consideration. Also, a general exemption for UK to UK transactions. And many of you may remember that UK transfer pricing used to only apply to cross-border transactions. But in order to comply with the EU regulations, it was widened to include UK to UK transactions, getting on for 20 years ago. Thin capitalisation rules. Arguably, the UK thin cap rules have fallen behind compared to OECD recommendations. So the particular areas that were being looked at was whether account should be taken for implicit support from a wider group when determining the amount and terms of debt that would be available at arm's length. And secondly, whether guarantees should be permitted that reduce the arm's length cost of borrowing to be taken into account when determining the terms of debt available at arm's length. And lastly, diverted profits tax. So this has been in place for a few years now, quite controversial when it was introduced. It's got two aspects to it. One is around diversion of profits to low tax jurisdictions where there's little substance, and the other is around artificial UK PEs. So that is another area which HMRC has been looking at. And in particular, one of the things about DPT is it's not corporation tax. So it's seen as a separate tax, and that limits the availability of relief under UK tax treaties, which has been rather controversial. So that was the UK consultation. So hot off the press, I haven't had time to look through all of the responses, but it looks like the participation rules, i.e. around connectedness, are going to be made slightly simpler. There's going to be some targeted rules around that, which hopefully will make the legislation more effective. It doesn't look like there's going to be a significant change around the one-way street. It does look as though there will be some relaxation of the UK to UK rules, which should ease the compliance burden for those that are affected. In particular, that will be a relaxation where there is no UK tax advantage. So in some situations, there can be a UK tax advantage. We wouldn't expect that to be exempted. On the thin capitalisation, it looks as though the rules will be replaced that disregard guarantees. So that looks like a step forward and an alignment with the broader OECD and case law precedent situation. So if you have time, have a look through the outcome of the transfer pricing consultation, and we may have another webinar on that subject in future. On a slightly separate matter, we also have new UK documentation rules, which came into place last year, effective from the 1st of April 2023. And for the first time, the UK statute had mandatory transfer pricing documentation rules. So say these are effective for accounting periods starting on or after the 1st of April 2023, and they required large groups, that's groups with over 750 million global turnover in euros, to have a master file and UK local file as set out in the UK guidelines, sorry, the OECD guidelines. So that was the first time that it was mandatory for groups of that size to have those documents. It's also worth noting that for businesses that are below that threshold, but are still within the transfer pricing rules, that's large businesses with over 250 employees globally, or 50 million euros of global turnover and more than 43 million euros of net assets, it's effectively necessary for those businesses to also have a master file and local files. Now, HMRC has never explicitly said that before, but they've always alluded or expected businesses to have OECD compliant documentation, which effectively means master file and local file. But last summer, they put this phrase into their published guidance. HMRC is of the view that an appropriate way to demonstrate that provisions between related parties adhere to the arm's length principle is to prepare documentation in line with the OECD's recommended approach, even where the multinational enterprise group test is not met. And what we're finding is, both in inquiries and business risk reviews, is if businesses are large but they don't have that documentation, then there's an expectancy from HMRC that penalties could apply because the rules haven't been complied with. So that's just something to be aware of. Just a few practical issues. Again, we had this new HMRC guidance last summer, so it's still relatively new. There are a few points to note here. I'm not going to go through them in detail, but you can aggregate transactions within a single category in a local file, which may help reduce the compliance burden. There are some materiality categories or thresholds which HMRC respect, although there are also some types of transaction which they will always consider material regardless of the value. Those are listed via that hyperlink in the HMRC guidance. But for other transactions outside of that, where the aggregate value of them does not exceed £1 million, those transactions do not need to be reported in the local file. The HMRC guidance then goes on to talk about local files, country files, and around a particular area as to whether you need one for each specific entity or whether you can just prepare one. Now, HMRC's guidance slightly contradicts itself by saying that a local file is an entity-specific document, and should be prepared on an entity-by-entity basis. However, multinational group may prepare an amalgamated country-specific local file. So that gives some flexibility, but we've sought clarification from HMRC on that because it seems to contradict itself. So just a few other points. First of all, the master file and local file need to be reviewed annually. And the reason for this is because they need to be kept up to date. So if your business changes during the course of a year, that needs to be reflected in your transfer pricing documentation. Also, the financial data for the comparables should be updated annually so that the arm's length principle can be tested reliably. That doesn't mean to say you need to do a full set of benchmarking annually. The OECD recommends every 3 years, but the actual comparables should be updated to check that you're compliant. Providing records to HMRC. HMRC can now request transfer pricing documentation outside of a formal inquiry, which is a significant change and which we are seeing in practice. So you don't need there's no need to have a formal inquiry for HMRC to request that documentation. And it needs to be provided within 30 days. So, excuse me, it's not the case that you can simply prepare it once they ask. It needs to be prepared and ready such that if a request is made, then it can be submitted within those 30 days. If not, those penalties apply. So we're expecting to see tougher enforcement by HMRC of penalties for non-compliance. There is a £3,000 penalty for each failure. We don't see that applied very often, but don't forget there's also tax-geared penalties for transfer pricing errors that are within tax returns and subject to an inquiry. Just one point here, we are seeing a lot more of HMRC asking for supporting documentations during business risk reviews. So they're not just asking for a local file and master file, they're asking for evidence of the systems, the processes, the manuals, the individuals who are preparing transfer pricing records, who are signing off adjustments, who are preparing agreements. This is now quite common, whereas it used to only take place during inquiries. So that's something to be aware of if you're subject to business risk reviews. So finally, I've just summed up transfer pricing life cycle, as it were. A couple of things to note on this slide is that HMRC have previously flagged 2 other potential measures to enforce compliance. One is called a summary audit trail, and what that is the backing and the methodology which you've used to compile your transfer pricing documentation. And they were planning to issue some form of questionnaire to taxpayers, which would oblige taxpayers to demonstrate the steps they've been through in order to compile their transfer pricing documentation. And that was supposed to be subject to further public consultation. The implementation is currently postponed, so we'll see what happens with that. In addition, some of you may remember that an international dealing schedule was proposed at one stage. That would have been an annex effectively to a tax return, setting out details of all cross-border transactions, which would again potentially have caused quite an onerous compliance burden. It's used in various other countries like Australia, the US, Canada. That also is on hold, but it's important to note that neither of those 2 measures are officially off the table. Although, of course, we have an election this year, so who knows what might be pushed forward. But just generally, the point of this slide is just to say you can no longer simply compile a master file and local file and forget about it. HMRC are being much more diligent in terms of looking beneath the documentation. They want to know how it's compiled and can you demonstrate that your transfer pricing policy feeds all the way through into your financial statements and tax returns. So unfortunately, it's a world we're now living in where transfer pricing compliance is more onerous than it used to be. And the outcome of the consultation that we've seen today will hopefully reduce some of that burden. I'm going to pass back to you, James.
Thank you, Ken. And finally, I think what we'd like to do here is summarise some of the other international tax reforms. I mean, there's been a huge amount of change in the international tax arena over the last few years. And what I think we'd like to do is just highlight a couple of those points that are kind of at the forefront at the moment. It's designed to be very much a high-level review. I mean, the topics here could be a webinar in their own right. But what we'd like to do is just give you a flavour of what the international tax landscape is looking like at the moment. And so this all really stems from the OECD, which have been looking at the international tax rules for a number of years now. And it stemmed from what they referred to as tax challenges arising from the digitalisation of the economy. And effectively, when you think of sort of tech businesses that have operating and business models that don't necessarily fit neatly into the traditional international tax rules that we were used to. The OECD is backed by what is known as a framework of countries, and that's about 140 countries now globally. So collectively, there is a lot of weight behind these changes, and we are seeing those already being introduced now. 2 points that I just wanted to cover in this session was on the OECD's proposals, which are referred to as Pillar 1 and Pillar 2. And these are the kind of core elements of changes at the moment. When you look at Pillar 1, it is really around the reallocation of taxing rights and targeting issues where there is business presence or commercial activity in a jurisdiction, but those activities don't necessarily correspond to a physical presence. And so what these rules are looking at is that the profits taxed in jurisdictions where actually the customers and or the users are located, and adjusting the international tax rules to ensure that the reallocation of taxing rights to those marking jurisdictions is fair. At the moment, there's still very much watch this space. There's been lots of changes, and some new rules will be introduced and announced as early as March this year. And there's quite ambitious targets to have those approved by the framework of countries by June 2024. What I wanted to spend a bit more time on now is the Pillar 2 proposals, which refer to a global anti-base erosion mechanism, or GLOBE as it's referred. And this refers to, effectively at its core, is ensuring that there's a minimum level of tax paid by multinational groups globally. And that minimum level of tax has been set at 15% effective tax rate. In terms of the current position, well, the UK has been an early adopter of this, and as has many other countries. And so these rules will be implemented with effect from the 1st of January this year. So we are already into seeing the impact of these rules on groups going forward. When we look at Pillar 2, what are the key points? Well, it only applies at the moment to the largest enterprises, so that 750 million euro turnover globally, where that threshold is met. But there is a look back period for that. So if you qualified in at least 2 of the last 4 previous accounting periods, then you would be within scope to the Pillar 2 rules. These rules are kind of designed to ensure, as I said, a minimum tax rate on income in every jurisdiction in which that multinational group operates. And so the framework looks to impose a top-up tax on those profits arising where that 15% effective tax rate hasn't been met. And there are various different ways in which this is actually achieved. The 2 core elements are what's known as an income inclusion rule and an under-taxed profits rule, which I'll come on to in a little bit more detail in a bit. But essentially, the timing of the implementation of those is slightly different, and it's country specific. So the OECD will put together the proposals, and it is then for those individual jurisdictions and countries to implement them in their own law. As I said, for the UK, 1st of January 24 has implemented the part of the Pillar 2 proposals. Alongside that income inclusion rule, we have what's known as a qualified domestic minimum top-up tax that works alongside the income inclusion rule. And several territories have also adopted this at the same point as the income inclusion rule in their legislation. The undertaxed profits rule, often refers to as a bit of a backstop to the income inclusion rule, is likely to follow in legislation 12 months later, again for the UK. We are expecting that from January 25 at the earliest. And in addition to that, there is various other mechanisms in terms of treaty-based provisions where you're looking at subject to tax rules. And what effectively that means is looking at where cross-border payments are made from one part of the group to another part of the group in a low-tax jurisdiction, and where that payer may be denied a deduction in its local domestic tax returns. When we look at those three elements in a bit more detail of the core elements of Pillar 2, we have the income inclusion rule. And as I say, it works by looking at the effective tax rate in the jurisdiction and applying that additional charge to the parent entity based on the difference between the effective rate and this 15%. It's very much, I guess, a top-down approach. So you look at the parent company and then its subsidiaries to see whether or not any of those subsidiaries are not meeting that effective tax rate. So the UK, as I said, has introduced legislation for this, referred to as the multinational top-up tax, charged on UK parent entities with non-UK subsidiaries. So the group's profits arising in the subsidiaries' territories, if they're less than 15%, then this top-up tax may apply. As I say, the qualified domestic minimum top-up tax kind of applies in parallel to that. And so what that looks at is purely a domestic level. So if you are a subsidiary within the group and your effective tax rate is less than 15%, certain countries are introducing legislation to ensure that actually your domestic tax charge meets that 15%. So the logic being that why would a subsidiary's jurisdiction not tax at that 15% if it was going to be taxed under the income inclusion rule of a parent? And again, the UK has implemented that at the same time as the income inclusion rule. And we have the undertaxed profits rule. I did refer to this as kind of a backstop to the income inclusion rule. And it would look to apply where if you have a parent in a jurisdiction that is not adopting the income inclusion rule, and for whatever reason the domestic minimum top-up rules do not apply equally, what this rule looks at is saying, well, if you're a subsidiary and you have other entities in your group that have profits taxed in low jurisdictions, then this undertaxed profit rule could apply to bring that effective tax rate up to 15%. The UK has draft legislation that's been issued, but as I say, at the moment, that's not going to apply into accounting beginning on or after 30th December 24. So when we look at that effective tax calculation, that's two components. One obviously is the tax, the other is the profit on which those tax is based. The rules generally look at an accounting-based measure for these. So when you look at the accounting profit or loss, that is then adjusted for specific items that or what we refer to as permanent differences. So that's decisions, say in domestic law, where as a policy you might not tax income from the dividends of subsidiaries passed up, which is quite common in a number of countries. So the idea is to make sure that it's a level playing field and that it is adjusted appropriately. Again, with the tax element of that calculation, it is also based on the tax charge per the financial statements, plus allowances for deferred tax. So what that does is ensures where the timing of the tax charge is slightly different to what is being recognised in the accounts for whatever difference in terms of timing of receipts of taxable receipts against an accruals basis, certain elements of deferred tax would come in. And once you've worked out what that effective tax rate is and what your top-up tax is, there are then even further complications or further provisions and exclusions, one of which is substance-based income inclusion, which recognises that you get an exclusion where you have a certain level of substance in a jurisdiction, and that's fixed based on 5% of payroll costs and tangible fixed assets. And so there are transitional rules applying to these as well to adjust your top-up amount accordingly. When we look at that in the context of safe harbours and exemptions, one important exemption that is worth noting is for Pillar 2, there is a general exclusion for international shipping profits. What that means is the OECD have recognised that actually shipping companies are taxed quite differently. We've already discussed the tonnage tax regime, which allows a taxation based on the tonnage of the vessels at a low, stable rate. That doesn't necessarily coincide with, obviously, the calculations under Pillar 2. So there is an exclusion for international shipping profits. But importantly, that is quite a narrow definition, and it is only the profits generated from voyages in international traffic. And if you may recall, when I was discussing the UK tonnage tax regime, UK tonnage tax does apply to much wider than just international traffic. There is another important caveat to make in this, is that there is a similar strategic and commercial test that applies to this exclusion. So the vessels must either be strategically or commercially managed in the territory in which that exclusion applies. So from a UK point of view, if you were claiming the shipping-based exemption for a UK entity, then the strategic or the commercial management of those vessels must all be in the UK. Slight distinction here is that if you picked up on a subtlety, the UK has a strategic and commercial management test. So both tests need to be satisfied for UK purposes of tonnage tax. For the international shipping exclusion, it's an or. So potentially you only need to meet one of those strategic or commercial management tests. And there is a further caveat in terms of there is an ancillary exemption. So if your income is not wholly related to international traffic, there is a certain category of ancillary income. Again, that's capped at 50% of your total profits. There is a broad sort of transitional harbour, or I guess a soft landing to these Pillar 2 rules, and generally they will apply for a limited period. So as you say here, from commencing before 31/26 or ending after June 28. And this is primarily based on a simplified approach using a group's transfer pricing country by country reporting report that's submitted with various different caveats in terms of a de minimis threshold test where the revenue is less than 10 million, or other simplified tests in terms of the effective tax rate, and also a routine profit test. So when we were referring to this substance-based inclusion, if the aggregate profit is less than that, then it would fall within that safe harbour. And then just to touch on a few other exemptions and safe harbours that will be coming through in terms of the undertaxed profits rules. There is at the moment a proposal that if your headline corporation tax rate in the jurisdiction is at least 20%, then these rules may not apply. Also, there is a de minimis test in terms of number of assets below 50 million. So that's I appreciate it's quite a detailed area of legislation, and there's several hundred pages of guidance and legislation around this, but hopefully that will provide a very basic overview of where we are. And that concludes our slides. So back to you, Richard.
Thank you very much, James and Ken. Absolutely sterling effort to get through all that material in that time. We do have some time left for our panel discussion, so welcome back, Katrina, as well. You haven't been forgotten. Looking at some of the things that were covered in the presentations, and also bringing in some of the questions that we've received online. Just to give Ken and James a little bit of a break, I had a question I wanted to put forward to Katrina. James outlined the proposals that will open up tonnage tax to ship management with the conditions attached. Could you just give a little bit of a view as to the commercial utility of extending tonnage tax to ship managers?
Thanks, Richard. So I think the context of this is quite important to understand, because we are yet to see what the actual impact would be on the market, and it'll take a few years for that to gain traction as people, work out whether it fits within their operations. So I think some of you, it's a bit of a niche bit of knowledge, but there is an equivalent regime in the EU called the 2009 Ship Managers Guidelines on applying the state aid rules to ship managers. And it's largely based on the model in Cyprus, where essentially in the EU, there are some countries which have also chosen to extend their tonnage tax regime to ship managers, third-party ship managers. But the regime was seen to be very focused on how Cyprus runs ship management. So when the UK was looking at where its initial inclusion of ship management, when in the inception of tonnage tax in about 2000, it was sort of deemed not viable. And then there was another look at it sort of 5 or 10 years, or sort of 10 years later, saying, well, I think because of the various thresholds, it has to be at least 25% of the tax that's been paid. And that was the limit within the EU state aid guidelines, that again, the UK was not kind of minded, well, whilst it was still a member of the EU, to kind of rock the boat. And this was then the opportunity came through the exit of the EU to kind of reform it and hopefully also be broadly in line with the UK trade and corporation agreement and with state aid and its sort of state aid agreements, which are obviously much looser than they used to be when we were members. So I think it's about those positive signals of trying to open up the regime as much as they can, but making sure that they are not sort of opening the door for a potential for abuse, even though there is a general anti-abuse provision within the regime. Nevertheless, I think the authorities were approaching this quite cautiously. And if we have strong evidence, as the trade association, that there are real inhibitors, and if there's ways to assuage those authorities that this is there are legitimate ways to use it, and by slight reforms, then we need to collate that evidence. For now, I think it remains to be seen what the commercial uptake will be for that, but we think it's a positive signal from government.
Thank you, Katrina. Yes, I think that's the point overall. It's giving another tool in the toolkit, in the UK tonnage tax toolkit, that is available to any shipping group, and recognising the international nature of shipping. Maybe I could just sort of, in a way, follow on from that and pose a question towards James. I think one of the things that has been visible and linked into very much to the OECD agenda has been a trend towards onshoring, and onshoring in the context of international shipping groups. With all that's going on, does in the international arena, does that play to the strengths of tonnage tax, or does it put tonnage tax at risk? I know you touched on the Pillar 2 pieces, and it's sort of, how do these two things fit together, I guess? Yeah,
and I think that's an important point, because actually there have been various changes in the international tax regime over the years. We've had rules around economic substance in some of those low tax jurisdictions, which give issues in terms of groups looking at actually where can they then base their operations. I mean, ultimately, you would like to think that anything is based on commercial decisions, and if the UK is seen as an attractive place to set up and base your shipping business, then obviously it needs a stable taxation regime to support that. And I think tonnage tax has done that, in terms of you have a lock-in period of 8 years, so you have that stability, you have that that certainty. But as with all countries, I think all countries are obviously, if there is, as we can see, because of the changes in terms of introducing effective tax rates on a global scale, businesses now need to look at, well, what are those shipping hubs? What are those shipping taxation regimes that are the most favourable for them. And so the UK has to stay competitive, and I think it needs to try to do that as much as possible against other established shipping hubs.
Very good. I'll come back to that point around competitiveness in a second. I just wanted to cover off very quickly, James, with you one of the questions in the chat room, because you touched on it in your presentation, and then just in response to that question, with what was the 10-year rule, now the 8-year rule, what happens at the end of year 8? I think, if I recall, the correct way of doing it is remembering to carry on for a further period of 8 years, and that therein lies the rub. Is that right?
Yeah, that's right. So you can make, once you elect in, and once you've made your election after 1st of April 22, that election lasts for 8 years. So before that, if you had elected in, your normal time limit of 10 years or whenever that applied would run. And then this 8-year period only applies to elections made after April 22. There's a huge amount of flexibility in when you make that election. You can make that election annually if you want to. And what that does is reset the clock for the next 8 years. So what you really need to look at in terms of if you are in that period is, as you say, to make sure that you submit a renewal election before your election window ends. I did briefly touch on the bridging election, but shouldn't be something that should be relied upon. You really need to sort of make sure that you know when your tonnage tax election expires.
Fine, that's great. Thank you for covering that point off. I'm mindful that we haven't got oodles of time left, but I think a point we touched on competitiveness of the UK tonnage tax offering. And maybe, Katrina, can I come back to you again with a further question? What further do you think should be done to strengthen the UK tonnage tax regime, building on what has been done in the past several years?
So I think it's important for us to take a stock take, because it's taken quite a while for us to get to the stage where we've had these fairly major changes in a way that were seen as the easier issues to tackle in terms of the attractiveness of the regime. So in some ways, if there are some wins from that, and the chamber does sort of statistical analyses, contracts work to do analyses on the impact of tonnage tax on the UK to make sure we've got that good evidence base, which we do. So because obviously the regime's been around for 24 years, there we've got good analyses to kind of showcase its the impact it's had. So I think we need to kind of monitor what these changes will have in terms of attracting, and in some ways everything is relative. If other countries regimes are better or worse than ours, that will also impact our attractiveness, but there are more difficult issues to look at if it was to be made incredibly attractive. But as ever, there's always a risk that if it's too attractive, then it might not be, it might be too good to be true, if that makes sense. And it's kind of subject to more political tinkering if it's to be seen to be, overly generous. So one of the unique things about our regime is we've got that seafarer training link, which was actually introduced by the Labour government as part of that package to attract more investment into shipping in the UK. So watch the space, but we'll see what happens.
Okay. James, Ken, is there anything you'd like to add in that arena?
I guess from my point, I'd echo what Katrina says in terms of, I guess certainty and stability it shouldn't be undervalued. Certainly, you don't want to make changes every year and not know where you are, because that will just increase the complexity, which I don't think anyone wants.
I had a sort of maybe a supplementary, just very quickly, because we haven't mentioned it so far in this webinar. Is there any way that an incentivization on decarbonisation of shipping can be linked in to tonnage tax potentially? Any thoughts on that across the panel?
I'm happy to start on that. I think the question of sticks and carrots on decarbonisation generally are quite political and tricky. There's all sorts of tools you can use. I think the question has been explored when it comes to tonnage tax, but I think the priority to keep that stability and certainty and sort of how much benefit you could receive as a result of a green, credit was slightly questionable, because if you're only, for example, contributing X amount, then really to expect more than that contribution out to the system was deemed to be, it would raise quite a few eyebrows. Again, if it was, if there are ship register kind of abilities to incentives, reduce fees, that's always welcome, but that's not going to touch the size of the amount needed for the transition.
Yeah, absolutely. Ken or James, anything? Yeah, I agree. Did you have anything to add in that space?
I mean, I suppose from, like you say, from a policy point of view, how low can you go with tonnage tax in terms of other credits to incentivise? I guess it's already designed as quite a low tax regime. Whether or not tax, I guess, is the carrot or the stick that actually would help with decarbonisation. I'm not so sure. But like as Katrina's kind of mentioned, it's something that's explored, and obviously there are other elements to and other schemes and rules out there in terms of thinking sort of the ETS and the energy trading schemes, in terms of there are already rules out there, whether or not more complexity would help.
Okay, thank you. I'm afraid to say our allotted time is up. We've covered a huge amount of material today. As I mentioned at the beginning, the recording of this webinar and the accompanying slides will be distributed to all attendees. Not today, I believe, but probably within the next 24, 48 hours. Any questions that we haven't covered that are in the chat room will be picked up and responded to by the appropriate panelists. I'm conscious there's quite a lot about the introduction of ship management to the UK tonnage tax regime, and some of those are quite straightforward and some of them are, perhaps slightly less clear. I think what I would highlight is the core UK tonnage tax regime for ship owning and operating has not been changed, other than the points that James mentioned. So that core system still remains there, and the ship management extension in UK tonnage tax relates to UK tonnage tax vessels. It's not something that extends more widely than that, and James did reference that in his presentation. So it just remains for me to thank all panelists for their contributions today, to Olga Jakes for providing the technical support. She's the lady behind the Maritime London logo, and thanks to all of you for attending. Wishing you all a good rest of the day ahead. Thank you very much, and goodbye.